Have you ever wondered what all this talk is about the Federal Reserve raising and cutting interest rates, inflation, deflation, and what it actually means? Well, in this video, we're going to cover what that means in detail and what it means for you and the impact it has on your money. We'll also look at what the markets are predicting will happen with interest rates this year. From Wall Street to Main Street, the Federal Reserve plays a pivotal role in shaping our economic landscape. So let's gain a deeper understanding of how the Fed's policies influence everything from inflation to employment rates and from savings to loans. Whether you're a seasoned investor or just starting out, my goal of this video is to better equip you with the knowledge you need to make more informed decisions about your finances. But before we dive into all that, if you'd like to see more videos like this, please hit that like button. It lets me know that the content I'm providing to you is important and that you'd like to see more of it. And feel free to subscribe as well. Thank you. So let's start out by discussing who the Fed is and what exactly their roles are. The Federal Reserve was created in 1913 by Congress and the Federal Reserve Act to serve as the nation's central bank. There's only one rate that the Fed controls, and that is the federal funds rate. That rate is what banks use to borrow money from one another in the short term. The role of the Federal Reserve is to monitor the financial system risks at home and abroad, and to help ensure the system supports a healthy economy for the U.S., for households, communities, and businesses. The Federal Reserve is also known as America's central bank, and it is responsible for conducting monetary policy and controlling the money supply. The Fed is the most powerful economic institution in the United States and perhaps the world. The Fed is comprised of an FOMC, or Federal Open Market Committee, and it holds 8 regularly scheduled meetings per year. The FOMC is a rotating 12-person panel within the Federal Reserve, headed by the Federal Reserve Chair. That person currently is Jerome Powell. Fed meetings are important because they allow us to have a clearer look into the economy. More specifically, the way interest rates change and are expected to shift. At the most recent meeting in January, the FOMC decided not to raise rates, and in fact will probably cut rates at some point this year. In June of 2022, inflation peaked at 9.1%, which caused the Federal Reserve to have a series of 11 interest rate hikes over the next several months. As of December 2023, inflation stood at 3.4%. So what exactly is inflation? According to the U.S. Department of Labor, inflation is defined as a general upward price movement of goods and services in an economy, which basically means stuff gets more expensive as the cost of making purchases rise. Now, inflation isn't always a bad thing. In fact, the Fed considers a modest amount of inflation as a key indicator of a healthy economy. As a benchmark, the Fed strives to keep inflation at around the 2% mark. 2% inflation is designed to keep the economy growing at a healthy pace and doesn't outpace wage growth. The difficulty comes when inflation rises faster than your wages do, like what we've experienced recently. People then lose purchasing power because the cost of the items and services rise faster than the dollar, making things more expensive. If inflation rises too quickly, then the Fed pushes interest rates higher. Therefore, it gets more expensive to borrow money. So things like home and car loans get more expensive to purchase. By increasing the cost to borrow money, the hope is that it will decrease consumer spending and slow inflation. This can in turn lead to a slowdown in the economy. On the flip side, when the economy is slowing, the Fed sometimes lowers interest rates to make it cheaper for people to borrow money. The hope is to encourage people to take out loans and spend more, which should stimulate the economy. Therefore, buying a home and taking out business loans become more affordable because interest rates are lower. Consumers will also be more apt to spend, which will put cash back into the economy. So how is your money affected by interest rates when it's held inside your checking and savings accounts? The interest rates inside of a traditional checking account are minimal at best. Interest checking accounts pay interest on your balance while offering the ease to deposit, withdraw, send, and spend money freely. According to the National FDIC data from January 16, 2024, the average checking account interest rate is 0.07% annual percentage yield, or APY. APY determines the amount of interest an account holder earns in a year. In this example, it would translate to $7 in earnings on a $10,000 deposit if left untouched for a year. While lowering interest rates is good for people looking to borrow money, it's not so good for those who are looking to save. Banks also use the federal funds rate as a benchmark for savings account yields, so when the Fed rate decreases, the interest rate on your high-yield savings account will also likely decrease. When the economy is strong, the opposite happens. That's why, in the long run, a high-yield savings account is a good idea no matter what. The Fed will often raise interest rates in a strong market to stabilize borrowing and spending, which makes credit more expensive, but give savings accounts an added edge. Banks often increase savings yields in a strong market, giving you a more lucrative place to stash your money. You'll tend to find a higher interest rate on things like high-yield savings accounts. This is where your money will earn the most interest inside of a bank. Typical interest rates can be upwards of 4.5%, which translates into $450 on a $10,000 deposit if left untouched for a year, which is much better than the $7 on a regular checking account. While the Federal Reserve doesn't set mortgage rates directly, it does influence them by making changes to the federal funds rate. Another thing that influences mortgage rates is inflation. The federal funds rate and mortgage rates usually move in the same direction. As I mentioned earlier, when the Fed makes it more expensive for banks to borrow money by raising the federal funds rate, the banks will in turn pass those higher costs on to their customers. Interest rates increase the cost of borrowing, including mortgage rates. The most common mortgage is a fixed-rate mortgage in terms of either 15 or 30 years. Fixed-rate mortgages are tied to the 10-year Treasury yield, which, when that goes up or down, fixed-rate mortgages follow suit. There is a direct link between inflation and mortgage rates. You may have heard people who bought a home in the late 70s and early 80s mention that they had double-digit mortgage rates, some as high as 17% for a 30-year mortgage. You heard that right. In the past century, periods of inflation in the United States were particularly high during both world wars and the Korean War. The most recent spike in inflation occurred during a time that was termed the Great Inflation. That started in the mid-1960s and lasted for almost 20 years and only began to subside in the early 1980s. During that time, the inflation rate soared from a low of 1.6% in 1965 to 14.6% in 1980. Similar to mortgage rate increases, car loans are affected too. Decisions made by the Federal Reserve to increase the benchmark rate do not directly impact auto loans, but rather the cost for banks to lend. According to recent data from Cox Automotive, the average transaction price for new cars in February 2024 is $48,759, a marginal increase from the previous month's $48,247. Couple that with high interest rates, the average monthly car payment for new cars is $726, while the average monthly car payment for used cars is $533. So now that we know what inflation is, how the Fed handles it, and how it affects you, I wanted to give you some practical tips on how to overcome it. While this isn't an exhaustive list, I wanted to cover some basic steps starting with investing wisely. Inflation erodes the purchasing power of your money over time, so investing in assets that typically outpace inflation can help preserve your wealth. These assets may include stocks, real estate, and commodities. Also maintain a diversified portfolio. Spreading your investments across different asset classes can help reduce risk and increase the likelihood of achieving positive returns, even in inflationary environments. If at all possible, find ways to increase your income through salary negotiations, a side hustle, or investing in your education and skills can help offset the impact of inflation on your expenses. A step that may get overlooked but is one of the most fundamental things you can do is to budget efficiently. Keeping a budget and cutting unnecessary expenses can help you save more money, which can be invested to offset inflation. Additionally, consider keeping an emergency fund to cover unexpected expenses without having to dip into your investments. I have several budgeting videos on this channel that I encourage you to watch. I would also recommend staying informed about economic indicators and adjust your investment strategy accordingly. Central bank policies, inflation rates, and market conditions can all affect the performance of your investments. It's widely predicted in 2024 that the Fed will make multiple interest rate cuts throughout the year. Ultimately, that means it should become more affordable to buy a home or a car, and that the interest rates should drop on your credit cards. Analysts with Fannie Mae and the Mortgage Bankers Association both project that rates will fall going into 2024 and throughout the next year. Fannie Mae economists expect rates to drop more quickly, falling below 6% by Q4 of 2024. Meanwhile, the MBA's forecast for Q4 2024 is 6.1% and 5.9% for Q1 2025. On the flip side, high interest savings accounts will see rates drop, meaning you won't get paid as much in interest as you are now. Managing inflation is not without its challenges. The Federal Reserve must strike a delicate balance between stimulating economic growth and preventing runaway inflation, taking into account various factors such as changes in consumer behavior, global economic conditions, and technological advances. Remember that overcoming inflation is a long-term endeavor, and it's essential to have a diversified and flexible financial strategy to adapt to changing economic conditions. Being prepared and increasing your financial literacy and education is the key to saving money. In order to be better prepared, educate yourself on the current federal funds rate and how rates shifting up or down affects you. With that said, thank you all so much for watching. I really hope that you liked this video and that you got something out of it. I encourage you to watch more videos as it relates to personal finance on this channel. And if you haven't already, please like and subscribe. Thank you so much for watching.